So today we're going to be talking about one of the hottest topics every 4 years. We've got markets and presidential elections. So in this video, I'm going to go over some pretty thought-provoking charts and hopefully reveal how markets have performed during these very politically charged years. So let's get into it. So you might be surprised to learn that 2024 this year has been the third best start to a presidential election year for US stocks. If you take a look at the chart here, only 1936 and 1928 saw better returns in their first 8 months. In fact, we've seen a 19.5% return so far in 2024. And historically, a strong start like this often means a solid finish. So while it's tempting to worry about all this election year drama, history suggests that the momentum might just keep rolling. So to me, this chart is all about perspective, and hopefully it shows us that while history might not repeat, it often rhymes. So I want to shift gears here a little bit and zoom out and take a look at the long haul. So this chart takes us all the way back to 1926 and shows us the growth of a $1,000 investment in the stock market over time, irrespective of which political party held the presidency. So that $1,000 would have climbed to a staggering $17.4 million by August 24. So you'll see two lines, one for the Democratic administrations and then another for the Republican ones. But the key takeaway here, is that the upward trend is consistent. So what we're really seeing is the power of staying invested over time, regardless of who's in charge. Now I want to talk a little bit about keeping politics out of your portfolio. This chart here highlights how $100,000 would have grown if you had stayed invested over the last 10 years versus investing only when a particular party was in power. So it turns out it's much better to stay the course than to try to outguess which party is going to have the most positive or boost the market in the biggest way. This visual to me really drives home the importance of sticking to your game plan. Next up, I want to look at market performance across the election cycle. So you might expect election years to be the most turbulent, but interestingly, at least it was interesting to me, that's not always the case. The chart here compares average annual returns for different types of years. We got presidential, midterm, and then the off years. So you'll notice that election years hold their own pretty well. So while politics surely are going to stir some emotions, historically, it hasn't really rocked the market as much as you might think. Now here's something that might surprise you. US stocks have actually lost money less often during election years. Since 1928, only about 16% of presidential election years have ended in negative territory. While most of those downturns were tied to major economic events like the Great Depression in 1932 or the financial crisis in 2008, this chart here clearly highlights that election years tend to fare better than the headlines might suggest. Election years can often feel sluggish in the beginning, but then they tend to ramp up in the latter half of the year. So here we're looking at average quarterly returns with a focus on how election years compare to non-election years. As the chart shows, the second half of the year, especially the fourth quarter, often sees a surge. So, if you're feeling jittery now, I would tell you to hang tight. History tells us that election years tend to end on a high note, as illustrated by the upward trend that you see here in these final bars. So let's talk about market volatility and how wild the stock market really is during election years. This chart, to me, answers that question by tracking the number of days with market swings of 2% or more, right? Big up days, big down days. What you'll notice is that most election years don't have extreme volatility except during major recessions. So here are the spikes like 2008, 2020 with COVID. Those are the exceptions. This visual to me paints a picture that for the most part, election years are relatively stable compared to what we might expect. So overall, what's the big takeaway here? Markets have a history of resilience during election years. And while volatility is definitely part of the game, it's rarely tied solely to who wins. We got to remember that time in the market usually beats timing the market. So with that all being said, if you'd like to talk more about what this means for your investments, please feel free to reach out. Happy to chat. Thanks for watching, and let's keep our focus on our long-term goals, not the short-term headlines. Stay on point.